Alright, so hello everyone, it's me, Viet here. So today we're just gonna do a test, so I'm pre-recording this part of chapter 8 because last time we already finished chapter 7. So we will see how it goes. If it is if you guys like this, and we can continue to do this, and if there's anything that you guys think that I can do better, or if there's anything I can do to make the quality of the video better, please let me know. Alright, so before we start with the chapters, I want to say thank you everyone for being patient with this whole process, with this pretty frustrating time to you and to me as well, and also to the other faculties as well, I think. So no one expected this pandemic to happen, but it happened. So now me and other faculty has been trying to figure out the best way to, and the fastest way to make the transition from a traditional class setting to an online settings. And there's a lot of errors and mistakes and frustration along the way, so please bear with us, and I hope you guys are okay. We haven't seen each other for 2 weeks now, so I hope you are okay. Please don't go outside or anything, anyway, just be safe. Alright, so so today we'll talk about chapter 8, and last time we were talking about chapter 5, 6, 7. So as you remember, after chapter 4, which can introduce about the tax formulas, then starting chapter 5, 6, and 7, we kind of go more deeper into each line item of the tax formula. Right, so we talk about gross income, we talk about for AGI deduction, then we talk about from AGI deductions, right? So all that will cover quite detailed in chapter 5, 6, and 7. So today we're gonna focus on the calculation, the computation of the tax, right, and tax credit. And you guys remember in chapter 4 we already talked about tax computation, right? But in chapter 4 it's just like an overview, trying to introduce us the tax formulas. And so today in chapter 8 we want to focus more into different type of taxes, and also talk a little bit about tax credits as well. Alright, so so let's start. So so firstly, let's just go do a little bit overview about what we have done, what we have learned in previous chapters, and actually in chapter 4. So we know that there are certain filing status, right, for taxpayers in U.S., right? So we have married filing jointly, we have single, we have head of household, we have qualified widowers, and if you are married and you don't want to file jointly with your spouse, then you can do marriage filing separately as well, So there are certain filing status that a taxpayer can qualify themselves, and then they have to follow the guideline based on the filing status that they are qualified, and we are familiar with the tax schedule and tax rate tables. So, and if you have done your reading, have done your homework, like at the end of the chapter, at the end of the textbook, I think in appendix D, they provide the tax schedule. So, and but don't worry about that. So in the exam, I'm going to provide everything regarding the tax rate schedule, just like the last test, So, so don't worry about that. Oh, and since we mentioned exams. So as you know, exam 8, not exam 8, exam 2, which cover chapter 5, 2nd, 7, 8, right, is scheduled to be next week. But right now, don't worry about that. We're going to reschedule the test, the exam later once we have a better idea of how we should proceed with the class. So don't worry about that. So my goal right now is to finish chapter 8 and then maybe create a video that cover all the essential elements that we did for chapter 5, 2nd, 7, and 8, just like a review session as we usually do. But okay, so let's come back to our chapters now. So all right, so let me close it up. All right, so and as we know that based on the tax filing status, the tax rate, this tax schedule is going to be different for each filing status. We have the for them, right? And then right, something like, well, what's the benefit and what the penalty to file jointly or to file separately, So we'll kind of talk about this in previous chapters, right? But today I just want to give you a brief example to see when you should file jointly with your spouse and when you should file separately, right? So in general, the rule of thumb is if both of you are very high earners, both the spouse receive high income, then it might not be a good idea, tax-wise, to file jointly, right? Because both the spouse may end up need to pay a little bit higher taxes compared to when they pay separately, right? And if only one spouse is a higher earner and the other spouse doesn't earn as much, then maybe it's a better idea to file jointly, right? So, but let's look at this brief example, and you can see what I mean. So, as you can see right here, there's two scenarios. The first scenario, there's both of the spouses are high income taxpayers, right? So the wife and the husband, both of them make $350,000, and if they file jointly, and if we apply the merit filing jointly schedule, with the combined income of $700,000 right here, they gonna have to pay around $200,000 of taxes, right? 197, 140 to be exact. If they file separately as an individual, the total combined tax that they have to pay is going to be 195, 387, which is a little bit less than compared to when they file jointly, right? So this is where the difference come from, right? This is where this couple may need to reconsider whether or not they want to file jointly or separately, right? Because if they file separately, the tax that they pay may be less than going to be $1,000, close to $2,000 less than compared to when they file jointly, right? So to them maybe $2,000 not that much, not that important, but still this is some penalty right there, right, to file jointly. So that's something to consider. So let's look at scenario 2 right here, when the wife is the one who make $700,000, right, and the husband is probably a stay-home husband, doesn't make any income. So still, in this scenario, as a couple, they still make $700,000, right? But so if they file jointly, they still need to pay 197, 140, right? But if they pay separately, then now the wife have to pay a lot of taxes more. Right? She has to pay 223, almost $224,000, while the husband pay nothing. So, but still combined, both of them together, right? The total amount of tax that the couple have to pay if they file separately is still going to be almost $224,000, which is $26,000 more than almost $27,000 more than if they file jointly, right? So still, right, under certain circumstances, a couple need to make a decision whether or not they want to file jointly or want to file separately, right? So if both but in general, the rule of thumb is if both the spouses earn a lot, right? It might make sense, it might, right, to file separately, but still, this is just tax-wise, right? And in general, if only one spouse is a high earners and the other spouse doesn't earn that much, then maybe it's much more sense to file jointly with the other spouse, right? But anyway, but what we just talk about is just in terms of tax-wise, right? So whether or not the couple want to pay more or less tax, just money-wise in general, but there's, as we know, right, there's many other reasons, non-tax reasons, why couple decide to file jointly or separately. So those options we're not talking about here, right? So if for some reason, let's say in the first scenario, if the two spouses still want to file jointly together because they love each other and they just want to do it together, then still fine, they can still make that decision, right? So it's all up to the decision of the taxpayers to choose between filing jointly with the spouse or to file separately, right? But what we just discussed here is in terms of tax, in terms of money-wise, right? So so from this example, I just want to show you briefly the general rule of thumb on whether or not taxpayers should decide to file jointly or separately with the spouse. All right. So what we just talk about is in terms of ordinary income rate or ordinary rate, right? So we know besides ordinary tax, there's many other kind of taxes that we have to pay, right? So in general, for taxpayer, for ordinary taxpayers, we have to pay our ordinary income rate. We have to pay tax on our ordinary income, and then most of it probably going to have some sort of investment rate. So then we have to consider whether or not we have long-term, we have capital gains of some sort, right? So as we already know from previous chapters, I actually want to give you a review here. So as we know, for if a taxpayer have long-term capital gains, right? Usually the capital gain are taxed at a much more preferable rate, right? Usually ranging from 0 to 20%. But most middle class or people pay around 50%, right? And there's a tax schedule in Appendix D as well, so you can look at that, right? So for long-term capital gain for qualified dividends, the taxpayer going to pay at a much preferable rate, right? So so just to do an exercise to do a review here, let's try to calculate. Let's calculate this lady tax liability together, So and I know for sure all of you know how to do this, but let's just, for the sake of the review, for the sake of the chapters, let's try to do this together, And it's most likely in the test you're going to see something like this again, so it never hurt to do this again, right? All right, so look at this. So this lady, she has taxable income of $145,000, right? So and then $70, and remember that notice that this the taxable income, right? So that means all of the deduction, all the 4 AGI deduction, all the non-AGI deduction already taken into consideration, right? So now we have the taxable income already, and they say her taxable income of $145 and $70 also includes $700 of qualified dividends, right? So that's another place that we have to pay attention to, right? And then we know that her status is head of household, right? So, and here I provide you with the the ordinary tax schedule for heads of household, and also schedule for the tax schedule for net capital gain and qualified dividends. So based on this, let's calculate her tax liability together. Right. So the first thing we have to do is to differentiate between ordinary income and qualified dividends, right? So we know that her total taxable income is $145 and $70, and out of which $700 of that is qualified dividends, right? So we know that $700 is going to be qualified dividends, and the rest, right, whatever the rest is going to be, her ordinary income, right? So we know, let's see, we calculate 145.07 45.070 subtract 700, so we have 144,370. So her ordinary income is going to be 144,370 dollars, and then her qualified dividend is going to be $700. Right, and the reason why we need to differentiate between these two, because they are taxed differently, right? That's why we have two tax schedule here, right? So okay, so let's work on the tax liabilities of the ordinary income first. So we know that her income is 144,370. So let's look at the tax schedule here. Right, so 144,370. So she's going to be on this bracket rate. So her income is in between 84,200 and 160,700. So we gonna use this tax bracket to calculate her tax liabilities for her ordinary income. All right, so oops. So we have tax liability for ordinary income. Right. So take $12,962 plus 24% times 144,370 subtract 54,200. How much is that? $12,962 plus 24%. It's going to be $27,402. So that is tax liability for ordinary income. So now let's calculate tax liabilities for the qualified dividend. So qualified dividend, it's going to be $700. So $700. So heads of household. So let's first we need to find her bracket, right? So her income is 145,070 So, and head of household. So she's going to be in this bracket rate, 50% rate. So like I said, most of the middle class rate, not middle class taxpayers going to pay 50%, 15% on qualified dividend on net capital gain. So just take $700 times 15 times 50%, 105. Alright, so the total tax liability is going to be the sum of that rate, so 27,402 plus 105 rate, which is going to be how much? Going to be 27,507. Alright, so that's her total tax liabilities, right? So, yeah, I'm sure every one of you probably already know how to do this, but I just want to give you a review, and just an exercise, to get just ourselves familiarized with this kind of problems, because most likely we're going to see this more often in the futures, in the test, Alright. So let's get back to our lectures. So very good, and I hope I can help you, can participate in solving this. So, just talking to myself right now, it's gonna feel weird. All right. So as we know, besides ordinary tax on ordinary income, right? There's many other type of taxes that tax on different kind of incomes, So in here, I just want to introduce you another kind of tax that is designed to target a certain taxpayers, So kiddie tax. So as you know, I'm not sure what chapter was that, probably chapter 2 or 3, when we talk about tax planning strategy, and one of the tax planning strategy is for taxpayers to shift income to another taxpayers who have lower marginal tax rate, or to shift the income to different geographic location that has lower tax rate, right? So for kiddie tax, is the tax that is designed to prevent the kind of activities, and in particular reduce the activities, reduce the activities of parent transferring income, shifting income to kids, So in the US, a lot of parents, they, for the sake of lowering their tax liabilities, they try to shift some of the properties to their children, So they put ownership of the assets into their children, So technically, the children is the owners of the assets, right? So, and these assets usually are income generating assets. So by doing that, now the one who pays the tax is going to be the children, right? Because they are the legitimate owners of the assets, not the parents anymore, right? So by that way, the parent can lower their official taxable income, right? And pay less tax. And at the same time, the children usually have much lower tax rate. The children usually have in much lower tax brackets, right? So they pay much less tax. That's why they're going to pay much less tax on the income generating from the asset that their parent transferred to them, right? So the kiddie tax is designed to reduce such activities, right? So, all right. So, what are the taxpayers that apply to this tax, to this kiddie tax. So usually this tax apply to kids that are under 18 years of age, or people who's under the age of 24 but is a full-time student, and the child, the person, the taxpayer's earned income is not greater than half of the support. So basically the parents still have to support majority of this person's library. So usually this is like college student, Alright, so how is this tax calculated? Right. So how is this tax calculated? Right. So like any tax, first we need to consider the base of the tax rate, which is the amount of income that's going to be that the taxpayer is going to be taxed on. Right. So the tax base for the kiddie tax is going to be the net unearned income. Right. It's going to be either whichever is lower. First, the net unearned income, which is equal to unearned income that exceeds 2200, right? And unearned income here is the unearned income coming from the assets that the parent already transferred to the kids, right? So let's say if the parent transfer some stocks, right? Let's say some Apple stock to the kids, and then somehow Apple somebody decided to give the kids, to give the shareholders some dividends, right? So now the dividends from the Apple stock that the kid receives is going to be treated as the income of the kids, right? So that's what I mean here. So that's what my net unearned income is, right? So that's the income coming from the assets that transfer from the parent to the kids, right? So the base of the kiddie tax is going to be the lesser of first net earned income, or second the child taxable income. If the child work and earn some income him or herself, then that can also be treated as a base rate. So whichever amount is lower, right? And then the net annual income or the child taxable income, right? So that's going to be that's going to be used as the base for the kiddie tax, right? So how is the tax? How is the kiddie tax calculated? What is the tax rate that we can use to calculate? Right. So let's walk through this scenario together, and during the process we going to discuss about how the kiddie tax calculated. Okay. So let's look at this example. All right. So it's during 2019, Darren kid, right, received $5,100 in an interest from an IBM bond. Right. And he received another $2,200 in interest income from a money market account that his parents have contributing for him over the years. So the question asked, what is Darren's taxable income in corresponding tax liabilities? So in this case, we know that Darren supposedly, you didn't say here, but let's assume he's the kid, right? He qualified for the kiddie tax, and his parents give him some bond and some money market assets that pays him $5,100 and $2,200 in interest income, right? So now in total, Darren's going to have $7,300, right, of unearned income from this kind of from this asset that his parents transfer to him, right? So let's see how we can calculate it. So yeah, so as we know, we assume that he's younger, right? And his unearned income exceeds $2,200, right? So he's subject to this tax, right? So okay, so let's focus on this. So how do we calculate this? Right. So the first thing that we need to do is to figure out the tax base for the kiddie tax rate. So as we know, the tax base is going to be whatever lower rate of net income or the child taxable income. So first, let's see which base should we use, right? So in here, the problem already shows us, right? So first, to be able to calculate the taxable income of the child, so we know the gross income of the child is going to be 7,300. Right? So that's the total income that the kid receives. Right? So the taxable income of the kid is going to be $7,300 subtract $1,100, which is the standard deductions, and we haven't covered this yet. But for taxpayers who are dependent of others taxpayers, right? Like in this case, Darren is a dependent of his parents. The standard deduction for dependent taxpayers is going to be $1,100, right? In general, it's going to be $1,100, and there's other cases, but in this case, it's $1,100, right? And yeah, don't worry if you're not familiar with this, but we haven't covered this yet. But yeah, in this case, $1,100. And if I ask this kind of question in a test, I want to just provide you with the standard deduction of the taxpayers, so you don't need to be worried like where to find this. I'm going to provide you this if I ask this kind of question on the test. All right. So we have the gross income and we have the standard deductions. So the taxable income of the kids, right, of Darren is going to be $6,200, right? And so that's the taxable income, right? So that's the first item. So now let's calculate the unearned, the net unearned income of Darren, right? So the net unearned income is going to be the total amount of unearned income subtract 2,200, right? So the total amount of unearned income here is $7,200 because all of his income are coming from the unearned income, right? So total unearned income subtract $2,200. So we have the net unearned income is $5,100, right? So after this step, right, we know that the taxable income is $6,200 and the net unearned income is $5,100, right? So we're gonna go with the lesser amount, right? So the tax base for the kiddie tax of Darren is going to be $5,100, right? So how do we calculate the tax liabilities for the kiddie tax? So for kiddie tax, we use tax rate from the trust and estate schedules. And you look at the chapter, you look at Schedule D, Appendix D in the textbook. You can see the trust and estate tax schedule. Actually, let me see if I can pull it up real quick to show you guys. Let's see. I have the book open up right here, the ebook. So let me see if I can pull up the tax rate. Alright, so here's the tax rate. So here's the tax rate schedule for the estates and trust. Right, so they have 4 brackets from $0 to $2,600, so on and so forth. Right, you can see. Right, so in this case, let's look at our case. So our case is going to be in between here, right, between $2,600 and $9,300, right? Because Darren tax base is $5,100, right? So he's going to be in this bracket, right? So like usual, we just apply the formulas to calculate the tax liabilities, right? So 260 plus 24% of 5,100 subtract 2,600, right? And what we get from that calculation is 860. So for the kiddie tax that Darren had have to pay $860, right? But it doesn't stop there, right? So beyond the kiddie tax, Darren still have to pay the income tax on the income that he paid, right? The income that he received, right? So how do we calculate that? So to be able to calculate the tax liabilities on the income that Darren received, the amount that go beyond the kiddie tax amount, right? So we take the taxable income, right, which we calculate right here is $6,200, subtract whatever amount that is already subjected to the kiddie tax rate. So whatever leftover from the taxable income, Darren still have to pay tax on that rate. So we have $6,200 subtract $5,100, and that comes to $1,100, right? So we know that beyond the kiddie tax, beyond the amount that Darren have to pay tax on the kiddie tax, right, he still have to pay tax on whatever leftover from his taxable income. So we know his taxable income, the amount that go beyond the kiddie tax amount is $1,100, right? So, and since this is not capital gain or qualified dividend or anything, so we're going to treat this income as ordinary income, right? So we're going to apply the ordinary rate for Darren, right? So Darren is a kid, and of course he's a single taxpayer. So we look at the single ordinary rate tax schedule to find out the tax rate for Darren, right? So Darren, the leftover amount is $1,100. So Darren's going to be this first bracket rate between $0 and $9,700, right? So that's why Darren's going to pay 10% of tax on this amount, on this $1,100. So which comes to the amount $110, right? So in total, Darren tax liability is going to be $97, which is the amount of the kiddie tax plus the amount of ordinary tax that Darren have to pay, right? So $860 plus $110 is going to be $97, right? So what I do want you guys to remember from this example, right? I want you to remember that first, you have to, for kiddie tax, you have to determine the tax base for the kiddie tax first, right? So it's going to be whatever the lesser amount of the net earned income of the taxpayers of the kid, right? Or the taxable income of the kid, right? So the first step is to calculate the taxable income and the net earned income of the taxpayers, right? And then we pick whatever amount is lower to be the tax base, right? And then once we have the tax base, we use the trust and estate tax rate to calculate the tax liabilities of the kiddie tax, right? And then if there's any leftover from the taxable income, when we still have to pay ordinary or whatever that income, depending on the status of the income, depending on the type of income, we have to pay tax on that leftover amount as well, right? So let's say if in this case the gross earned income is, let's say, higher than 6,200, just for the sake of the argument here, let's say in this case the tax base, the kiddie tax is not $5,100 but $6,200, right? We pick the taxable incomes, right? Then that means the base of the kiddie tax is going to be the total amount of the taxable income, right? And after the kiddie tax, after the kid pays the kiddie tax, he or she doesn't have to pay any leftover, right? Because that's the base, right? There's no leftover from taxable income anymore, right? So if the kid have to use the taxable income as a tax base for the kitty tax, then he or she don't have to pay any leftover for the taxable income rate, for the ordinary income rate, or net capital gain or qualified dividend. It all depend on the status of that leftover income rate. So yeah. So again, I just want to introduce you to this kitty tax concept, and then walk through this example for you to have a better idea of what kitty tax is and how to calculate the kitty tax, right? But yeah, so I'm not going to go any more deeper into this topic, and for the test, if I decide to ask anything about the kitty tax, it should only come from whatever I covered today, So yeah, all right. So let's move on. All right. So what we should talk about is kitty tax, right? And again, kitty tax is the tax that is designed to target people who want to transfer asset generating income to their kids, right? To kind of avoid paying taxes, right? So next, I want to introduce to you another kind of tax with somehow similar purpose, So it's called AMT, or alternative minimum tax. So alternative minimum tax is designed to mainly, before it has been around for quite a while, for probably more than 50 or 60 years already. So the main purpose of AMT initially to design to be to make sure that the taxpayers are able to pay. The taxpayer must pay some amount, some minimum amount, because over time during the course of history, taxpayers has always tried to find a way to avoid paying tax, right? So that's why the government, the Congress, trying to has spent a lot of effort in terms of stopping people to avoid tax, right? So AMT was born for that mission, to make sure that taxpayers always have to pay some sort of minimum kind of tax, to make sure that they pay some level of taxes, But then over the time, the mission of AMT, or alternative minimum tax, has changed a little bit, and right now AMT does not really target people with low to medium income, So right now, under the new tax law, AMT just focus on targeting the people with very high income, high earners, right? So because these people are usually, they have way more channels to avoid tax, So yeah, so nowadays AMT is just mainly used to apply to high income individuals. So that's just a little bit of background on AMT. So what exactly is AMT? So AMT, you can think of it as just a tax. It is a tax, and the way to calculate this is relatively similar to the way to calculate ordinary tax. So, but the tax base is a little bit different from ordinary tax. Right? So for AMT, we have to calculate an alternative tax base that are different from the ordinary tax that we usually calculate, right? So that's basically, and then the tax rate is a little bit different as well. But the main difference is the tax base. So the tax base for AMTs is a bit different from ordinary income tax. So let's look at the formula for AMT, right? So for AMT, first, right, we're going to start with regular taxable income. Right? So this regular taxable income is going to be the income, the taxable income that are calculated using the traditional tax formula, right? So your gross, you have gross incomes, you subtract from AGI for AGI deductions, and then you get to a taxable income, right? So this is going to be the amount that we use to start here. And then, as I said, right, the base for the AMT is different, a little bit different from the taxable income, right? So, and the reason why it's different is that we have to add and subtract some components, make some adjustment to the taxable income to get to the base amount, right? So what exactly do we add and what exactly do we subtract? So usually we add standard deductions, right? If the taxpayer use standard deduction in calculating their from AGI deductions, right? And then subtract and or plus like some other adjustment, and we're going to talk about this adjustment in a little bit, right? So after that, we're going to get to the alternative minimum taxable income, right? And then with this amount, we're going to subtract some exemption amount, right? And we're also going to talk about this as well, right? So with that, we're going to get to our tax base, and this tax base is going to be the base where we're going to apply some tax rate to calculate the tax liabilities, right? And as I mentioned, the AMT tax rate is also a little bit different from the ordinary tax rate as well. So they have their own tax schedules, right? But much more simpler. So we're going to discuss about this in a little bit as well, right? And then after apply the tax rate, we have a tentative minimum tax, right? And then at this point, we're going to compare the tentative minimum tax with the regular tax. So if the tentative minimum tax is greater than the regular tax, then we have to pay the different, right, the amount that exceeds regular tax. Right? But if the tentative minimum tax is less than regular tax, then we don't have to pay any AMT as well. Right? So that's why AMT in these days is only target high income people, right? High income taxpayers, because if people with high tentative minimum tax rate after all of this adjustment, right? So yeah, so okay, so let's go through each item of this formula, right? So let's go. Let's start. Alright, so first of all, I just want to talk a little bit about what we can add and what we can subtract from the regular taxable income, right, to get to the base amount here, right? So here are some of the common items that people usually can add back to the regular taxable income, right? So tax exempt interest from private activity bonds, and the definition of private activity bonds is it's a little bit vague, so it's not municipal bond, it can be municipal bond, but if a municipal bond is used for some private activities, then it can also be considered as a private activity bond, So for example, let's say the city of San Antonio issues a bond, but the bond is to be used to build a public library, let's say. So then, because the library is used for public purposes, right? Then the library then the bond can be considered as a public activity bond, right? And in that case, the tax exempt interest coming from that bond, we don't need to add back to the regular income here, right? But if same thing, if it is a municipal bond issued by the city of San Antonio, but it is used to build, let's say, to to build a new Alamo Dome, a new stadium for the sport teams, and the sport teams are going to use that for their private activities. Then that bond, even though it's a municipal bond, tax exempt bond, but it is still going to be considered as a private activity bond. And then whatever tax exempt interest that you receive from that bond, you still have to add back to the regular income, regular taxable income. Right? So, all right. So tax exempt interest from private activity bonds, and also add back state income taxes, right? And real property taxes. So, but these two amounts only limit to $10,000, right? So if you pay more than $10,000 in terms of income tax or real property taxes, you don't have to include that in here. It's maxed out $10,000. All right. So and here is just a figure that I cut out from the book, and it's give a little bit more detail, more items, that people usually use to calculate AMT, So we already talk about these three items, right? So there's also depreciations, right? So depreciation. So depreciation, so let's say if during the year you use some sort of depreciation on some asset that you own as a deduction, then you may have to calculate, and you may have to calculate, like to see whether or not you can add or minus the depreciation into the regular taxable income rate. And the way you do it, I'm not going to go more deeper in this item, but the way you do it is you have to calculate an AMT depreciation and compare that with your regular depreciations, and if the regular depreciation is greater than the AMT depreciation, then you have to add back that difference between the depreciation amount, to the taxable income. But if the AMT depreciation is greater than the regular depreciation, then you can subtract the difference there, right? So yeah, so just I just want to introduce you this item, but I'm not going to go deeper into this item, right? All right, how about some minus adjustments? So if you receive some refund from the state, because you pay state income tax, and somehow you receive a refund, then you can subtract that refund from the regular income tax, even though in the regular taxable income you have to add that back, right? Remember, but in here you don't need to. You can subtract that, and then also you can subtract any gain or losses, the sale of depreciable assets during the year, right? So if you receive a gain from the sales during the year, right, and you include that in the taxable income, then you can subtract that from the taxable income to calculate AMT. But if you receive a loss and you use it as a deduction, then you can add back those deductions, right, to calculate the AMT income, right? So yeah, so I just want to introduce you to some of the common items that taxpayers usually use to make the adjustment to calculate the base for the AMT, right, from the regular taxable income, right? So yeah, so it's just for your references, okay? All right, so let's go through this example together to be able to understand it a little bit better, right? So the example is say calculate AMT income for Courtney, who has the following items. So taxable income $145,070, and beside that she also have some tax. Also including that, she has some tax exempt interest income on Cincinnati bond used to pay for the construction of a Major League Baseball stadium for $500. She also have a mortgage interest expenses for the amount of $15,800, and she also have a real property tax on her home, which is $2,700, and then she received a refund from the state income that she paid in the amount of $420. So now we have to calculate, right? We have to make the adjustments to calculate her AMT income, right? So let's see. Let's try to work on this together. Okay. So let me pull up a Word file real quick. Let's see if I can type the answer. Okay. So this was. Alright, so let's start a new page. So we know her taxable income is 145,070. Okay, and then we have the tax-exempt interest rate. So $500 from the tax-exempt interest on the CCNT bond used to pay for renovation of a Major League Baseball stadium. So this we can consider as a private activity bond, right? Because it's not used to build the public facilities or public purpose. It's not used for public purpose. So we can consider it as a private activity bond. And with that, we need to add back this tax-exempt interest rate. So the tax-exempt interest plus $500. I'm trying to make this look better. So we add this back. Then next we have what else? We have the home mortgage interest expense and the real estate taxes on her home, right? So as we know from this list, that any real property taxes real properties and personal property tax deduct as itemized deductions. Okay, and we also have to add back, right? So as we know, the home mortgage interest expense and the real property tax can be deducted as an itemized item, right? So now we have to add back these two items. However, the limit on this item rate is only $10,000. So in here, even though we have like $15,800 plus $2,700, it's going to be like $18,500. The limit for the amount to be added back is only $10,000. So that's why we only add back $10,000. So we have real property. $10,000. Right. Now on top of that, we have the state income refunds. For the state income refund, we have to subtract it from taxable income rate, because we don't include that. Right. So state income refund, we subtract $420. Alright, so in total, how much do we have for the AMT income? $145,070 plus 500 plus 10,000, subtract 420. We have 155, 150. So $150,000. And this is the AMT income of this lady. Right. So this problems with this problem, I just want to walk us through some of the common items that we have to make adjustment, to the regular taxable income in order to get to the AMT income, right? All right. So let's get back to our slides. So remember the formula for AMT, right? So after we have the regular taxable income, after we make some adjustment, add on and subtract some of the adjustments, we get the AMT income, which we just calculated in the example, right? And then after that, we also need to subtract AMT exemption amount, right? So the AMT exemption amount is shown in here. So we have, depending on the filing status of the taxpayers, then we have a different exemption amount for the taxpayers, for different taxpayers. So for merit filing jointly, the exemption is $111,000 and $700. For merit filing separately, the amount is half, $55,850. And for head of household and single taxpayers, the exemption amount is $71,700. Right? But this exemption is going to phase out after a certain threshold, right? So the phase out for merit filing jointly start at $1,020,020,600, and then the rate of phasing out is 25%, right? For every 25 cents for every dollars, right? So the exemption can be completely phased out at $1,467,400 for merit filing jointly, right? And then for the other two type of filing status, we also have a phase out system, right? So starting from $10,300 and then ending at the $7,733,700, right? So anyway, so if your AMT income is less than $1 million, if you merit filing jointly, or less than $500,000 if you are the other type of taxpayers, then you should be fine. You should be able to use all the whole amount of the exemption to use that to subtract from your AMT income. So okay, so now we can calculate the quarterly AMT base, right? So we know quarterly from our previous example. Sorry, I'm running into some technical difficulty here. Not sure what's going on with my laptop. What's going on? Alright, I have to do this now. So remember from the previous example we saw, right? We solved together, right? We have the ANT income is 155, 150s. So look at, with that, we know that Courtney, this lady, she's head of household, right? And her AMT income is $155,000, which is way less than the phase out beginning amount, right? So that means Courtney can use the whole amount of exemption, which is $71,700, right? So Courtney can use how much? can use sorry, I'm not sure what's going on with my laptop. Can use 71,700. $71,700 as her right. So with that, we can calculate her. We know that she can use 71,700 as her exemption, right? The full amount, right? So then we can from that we can calculate her AMT base, right? So to calculate her AMT base, let's look at the formula again, right? So her AMT, so from AMT income, we subtract AMT income by the AMT exemption amount, right? And then we get to the tax base of the AMT, the tax base for the AMT, right? So with this, we can take 150 subtract 71,700, which can equals $83,450. So this is going to be her base, right? So from here, we can apply the AMT tax rate and calculate her tentative AMT, right? Her tentative AMT liabilities. Right? So what is the tax rate that we can use, right? And what is the tax schedule that we can use to calculate AMT, right? So for AMT tax schedule is a little bit more simpler compared to ordinary tax schedule, right? So there's only two brackets, right? So first, if your AMT base is less than or equal to $194,800, then there's a flat rate of 26%, right? For all taxpayers except for married filing jointly. So if you're married filing jointly, the threshold is going to be only $97,400, right? So if you exceed this threshold, then you have to jump to the second bracket, which is 28%. Right? So 28% is going to be the tax rate for taxpayer who AMT base exceeds $194,800 for all other taxpayers, and for marriage filing separately, this threshold is going to be $97,400. Right? And it's a flat tax rate, so we just apply 26% times or 28% times the AMT base. Right? It's very straightforward. All right. So let's calculate this lady Courtney's AMT or tentative AMT. Right? So let's look at the formula again. Right? So with the tax base and with AMT rate, then we can calculate the tentative minimum tax rate. Well, and then from there we're going to compare the tentative minimum tax with the regular tax, right? And if the tentative minimum tax greater than the regular tax, then the taxpayer have to pay the difference amount, right? But if not, then the taxpayer doesn't have to pay any AMT at all, right? So so with that, let's calculate the tentative minimum tax. Right, so we know Courtney's tax pay AMT pay is 83,450. Alright, so we take 83,450 times, well, and then because it is less than 194,800 rate, so she can use the 26% tax rate because she's a head of household, right? So she can use 26%. So we have 83,450 times 26%. 26%. It's going to be equal. Equal 21,697. 21,697. Alright, so now we have so this is all the tentative minimum tax, right? Alright, so now what we do is we compare this amount with the regular tax liabilities, right? So let's say the board doesn't give us a regular tax amount for Courtney, but let's say the regular tax, let's say it is $25,000. Let's just say, for the sake of our problems here. So if that's the case, then Courtney AMT is going to be 0, right? Because her tentative minimum tax is less than her regular tax rate. So we have $21,697 compared to $25,000, right? So her AMT is going to be 0 in this case, right? Alright, so I guess, let's see. So I guess I will stop this video here, and because this have been running for like an hour already. So yeah, so I will keep making other videos for the rest of the chapters, and if you have time, I will make a separate video to cover some of the practice problems, that you may see in the homework as well, because some of you have suggested me to cover more practice problems, since now we are using video format, and we have more time to do so. So yeah, so I'll see if I have some time. I will make another video to cover probably the rest of the chapters, the content of the rest of the chapters, and if I have some more time, I will also cover some of the practice problems, that you will see in your homework as well. Okay, so great. I will see you in the next video.